Thank you for having me here. My name is Christian Wood. I'm a principal in our Washington National Tax. I head up we call it the Credits Incentive Methods Group. So it's federal credits incentives, and it's also the umbrella which under energy. And so that's why I'm here speaking to you today and why my last weeks have been fairly busy. So most of this presentation is going to be sort of through the lens of what the Inflation Reduction Act meant to do. And so some of it also is my journey. And so like one of the importance of sustainability is reducing the impact of external market fluctuations. Like I went and finally decided last year to buy an electric vehicle. It wasn't available, like most of them weren't. So I put a down payment on it. They said 6 to 9 months. I called in this summer. I was like, all right, is it close to being done? They're like, no, not even close. Hasn't even started. The war in Ukraine is throwing us off. Like I did not anticipate that. Or the volatility of fossil fuels. It was a personal story. My youngest plays hockey and it's all over the East Coast. And my wife was going to take him for a hockey game. This was during when the pipeline got hacked and gas sort of was being distributed, and all of a sudden gas stations were running out of gas. And so luckily he was able to find a friend who had an electric car. Otherwise he would have been able to make it. And so I think the Inflation Reduction Act is sort of trying to limit sort of the volatility of the world on the United States. And it wants to sort of promote a variety of alternatives so that no one input can take down or at least put a dent in businesses. So it's also important because, and we've talked a little bit about this earlier, every stakeholder in a business is interested in sustainability and ESG. Your customers. Like for instance, millennials are now overtaking like the largest group in the workforce. Millennials are much more mission driven in their decisions on day-to-day activities than prior generations. And so as customers, they're going to demand, or going to take their business to companies that are practicing sustainability. Suppliers, they're also going to be looking at sustainability. And so you as a company either need to worry about your suppliers adding to your sustainability, or your suppliers are going to worry about you. Employees, as the millennials sort of take over the workforce, they will go and move their talent to jobs they find rewarding socially. So it's always sort of important to keep in mind. Board members, we've talked a little about that. They're just sort of interested in making sure the business is well run. It can't be well run without taking sustainability into account. And then the capital markets. And so we've heard from our two speakers before how sustainability is impacting how people can get capital and under what terms. And then another sort of note is like the millennials are set over their generation to inherit about $30 trillion of wealth through inheritance. And so they're going to be a major contributor to capital markets and sources of funding going forward. And as long as they continue to make these decisions based on their mission, mission-driven decisions, it's going to have an impact. And I think we'll continue to have an impact for the foreseeable future. So what we look at from sort of a business point of view, sustainability and ESG to some degree. There's a growing body of literature that sort of shows that they get a better return than not. I mean, to me, sustainability really is just good corporate governance. And so those who have good corporate governance end up with higher returns. But in a world of limited resources, what do we sort of do? How do we and what do we invest in? A lot of it's going to be dependent upon a return on investment. And so for sustainability and green measures, often they cost more than non-sustainability alternatives. We sort of call that the green premium. And so either people are willing to pay more for products, or we need technology to create better, more efficient uses to sort of reduce the green premium. If we can get rid of the green premium, that would be ideal. And so one of the ways we can do that is through incentives for the federal government and the state governments to a degree too. So there's two ways. One is to reduce the after-tax cost of renewable project development. So sort of producing things costs cheaper. That reduces the green premium. Or we incentivize individuals to purchase new and efficient like appliances and vehicles. And so the consumers are getting a refund, so they're willing to pay more for sustainability options. So that's where we get to the Inflation Reduction Act. It's kind of an interesting act, and I'll get to that in a moment. These are just the tax provisions. You can see the revenues raisers, and that's what I'm focusing on is tax because that's what I do. And you can see where they sort of invested in credits and deductions as far as green energy. The biggest by far is clean electricity and reducing carbon emissions. And you'll see that throughout the act. And then you can see the other priorities, clean fuels, clean individuals, clean vehicles, manufacturing. They even have some grants where people sort of put together projects. They go submit it to the federal government, they rate it, and issue grants that way. So $271 billion is a significant investment. It's one of the biggest investments in sustainability and green energy the federal government has made. Some of the math in here, you'll see that one of the sources of revenues projections is Irs Funding. The bill is going to pay $80 million to give the IRS more people, and with that $80 million, they're going to in turn raise $204 billion is what CBO projected, and so it ends up being a net of 104. I think it's 104 billion, and so that's how the math sort of works out. So the act itself is over 700 pages. The provisions and the text related to the tax provisions are over 300. And so it's quite a bit to go through. What I like about the act is I think it's actually well put together for the most part. There are some problems with it, and there are some you can see that sort of got negotiated at the last minute. But there's sort of three things that the act is trying to do, at least from the energy. One is reduce carbon emissions. Two is to create sort of domestic energy sustainability and not have to rely on foreign powers. And the other part that isn't getting a lot of play is it's supposed to generate jobs. Good jobs, good paying jobs. And it does this through, some of the requirements are you have to pay a prevailing wage in order to qualify for an enhanced credit. You have to have apprentice programs. And there are some of the provisions give you a bonus for putting them in areas that, used to have a car manufacturer that's no longer there, or sort of low income areas. It's supposed to generate good paying jobs. Now, we can argue in the act whether this is going to reward new behavior or just sort of reward behavior that was already set in place. But I think even if you're cynical and said it's just going to reward behavior that's already in place, because of these job requirements, I think it's going to actually create more jobs than if the act had never existed. So you can see sort of how it sort of flows out. And you'll notice sort of the blue versus the green. In negotiating this act, the House was focused on sort of extending, bringing back credits that expired, and that was their approach. The Senate wanted to sort of do technology neutral and sort of reward behavior, not necessarily technology. And so when they blended the bills together, you'll see the split where for the first couple of years through 2024, it's kind of an extension, bringing a couple that expired back of credits. And then starting in 25 going forward, it's more technology neutral and is rewarding behavior. And so that's where you kind of to see is like, well, why are all these differences between the 2 years? So they have the production tax credit and the investment tax credit already exists. The production tax credit gives you an amount to recover over 10 years based on production. The investment tax credit is a one-time deduction. There are going to be situations where you're going to qualify for both. And you can make the election to apply the investment tax credit. And so the more I'm in tax, or the longer it is, the more tax gets complicated, right? A lot of this stuff is going to be dependent on, does it make sense and what can I take advantage of? It's going to depend on modeling. What are your short-term goals? What are your long-term goals? What is your current tax position? What are your other goals? And so, whether it makes sense to do the production tax credit or an investment tax credit depends upon what you're going to do in the future. They also expanded, so solar's back into the production tax credit. And then there's a bunch of technologies that sort of had fallen out or didn't qualify because they're relatively new are now being included. So that would be battery storage, which the industry has long lobbied for and they finally got. Interconnections, that's creating the power to distribute. Renewable natural gas, microgrids, dynamic glass, and so there's sort of new technologies. 45Q carbon Capture is the one more. It sort of has increasing rates, and a lot of these rates start at a base rate. And then if you can meet the prevailing wage and the apprenticeship program, you get like a multiple of 5 of that credit. And so it could be significant. And so you're going to want to probably make sure that, all right, what's the cost to qualify for it? Does it make sense? Probably will. This also introduced a new thing called direct pay and transferability. There are going to be situations where a taxpayer may not be able to take advantage of the credit. And so in certain types of taxpayers and for the 45Q credit, you can elect to treat the credit as a payment of tax in the current year, so that if you don't fully utilize it, it gets refunded to you. And so you get cash. And so, a lot of times we've got clients that say, we use these credits. Well, I can't use them right now. All right, then we're not going to do anything. Whereas this one says, well, you can use it. You can get the cash to immediately reduce your current costs. And then there's going to be certain situations where they're going to allow for sort of a transferability of it. That one should be kind of interesting, because I think in my head of sort of exam, and IRS agent comes up to your company and says, oh, you took a credit. Let me see your wind farm. I don't have a wind farm. How'd you get the credit? I bought it. Well, where's their wind farm? I don't know who I bought it from. I bought it on exchange. It's like, how do you enforce that? And so I think while there are good things about the Act, there are also going to be some challenges about the Act too. All right, so a lot of this stuff, some of the talks I think are going to overlap with each other a lot. You did notice that someone threw out a 2050 date. Part of the clean fuels portion of the Inflation Reduction Act is the Sustainable Aviation Fuel, which is $1.75 per gallon credit. And the federal government is working with the airlines so that by 2050, they use 100% of the sustainable aviation fuel. And so this is to sort of help support that. Clean vehicles. I was kind of excited, right? Okay, I'm going to get an electric car. I get my credit. It's, it wasn't a Prius, because those had all been used up under the old rules. So it's like, all right, I should be fine. Then the new rules came out. And the new rules said, well, we're no longer going to have the cap. Because it used to be like the first 200,000 of vehicles produced got a credit, and then sort of phased down until it stopped. So Priuses had long since, like, that's no longer there. Everyone gets sort of the, if you qualify, I think 3750 credit and 3750 credit, so you're back to 750. Now there's income limitations. I think this was a large part in Manchin's, is because he was concerned that why should they give subsidies to people when people are on wait lists to buy these cars. And so the income limitations are relatively low. If you live in a major city, you're probably not going to necessarily qualify for this credit. And then for sales that are entered into after the signing of the Act, but before December 31st of this year, there's now a requirement where you're under the old rules for the credit, but the new rule says that has to be manufactured or assembled in the United States. And so a lot of people are going to lose out just because of that part, because a lot of the parts are made abroad. I do know that there were several companies that sort of reached out to people who were on wait lists, who had paid sort of a modest deposit and tried to sort of say, hey, listen, enter into a binding contract prior to the president signing this. You'll be under the old rules, no income limitations, no this, no that. I know most of them looking at what the federal government considers a binding contract, that if you entered into before, you're sort of completely under the old rules, won't qualify. And so I think there's going to be a lot of people who intended to bank on getting that credit or not going to get it any further. Also, there's now for commercial vehicles up to 40,000 per vehicle. One of the ways they measured it is sort of what is a comparable vehicle not. All right, I need a delivery van. What's one on a combustible engine that takes gas? Okay, now what's the electric version of that? What's the difference in price? That's what the credit applies to. So it should help companies buy electric fleets. And there's a new credit going forward that 4,000 for used vehicles. One piece of guidance has come out by the Treasury under this, and it came out pretty quickly. It has to do with, there's now a website where you can go put in the VIN number of the vehicle you purchased, and it will tell you if you qualify for the credit to make it a little bit easier. So If you had a written binding contract prior to President signing, all old rules. If you didn't have a written binding contract, but you acquired it before December 31st, old rules, except it had to be assembled in the United States. If it's after January 1, where you purchase the vehicle, it's all under new rules with the income limitations and things of that nature. So there's some new stuff. I've talked about the prevailing wage, the apprenticeship hours, which I think is kind of interesting to sort of encourage jobs in the US. Some places it depends upon like EV charging stations, where you're going to place it. If it's in a high urban tract or a wealthy neighborhood, may not qualify for a credit. And so it's going to be sort of important where things go. And so now it's just another input when you're deciding how to sort of move forward with your business. One of the nice things, I'll go back to the EV credit for individuals, is if you do qualify for it starting in January, you can assign it to the dealer, so it just becomes off the price tag immediately, so you don't have to wait to file a return for taxes and get the money back. Vehicle weight. It's 14,000 is what sort of pulls it into the vehicle. So a couple of different new things or new opportunities. Refundable credits is what I talked about, that if you can't use it, let's say you're a not-for-profit or a municipality, you engage in behavior the federal government says we would like to give you credit for, you say, great, I don't have any taxes due. They say, go ahead and treat it as a payment of tax and you can get it refunded. And so a lot of those are for not all taxpayers, it's for a limited window of taxpayers, but the 45Q expands that to most taxpayers for the carbon sequestration. One of the things about carbon sequestration is there's this really lucrative credit of $180 per metric ton that you pull out of the air. It's to sort of support the nascent technology of creating machines that just pull carbon straight out of the air. So if the second speaker's project really hits, it's going to be very valuable from a tax credit standpoint. There's going to be new markets to sell credits. Talked a little bit about that. If you can't use it, you might be able to sell it to somebody who can use it. You get the benefit of it. There was an interesting tweet thread that I sort of read on ESG and selling of the credits and whether or not that's going to be counterintuitive. So it'll be interesting to sort of see how that works going forward with this new market. And then the last one is talking about I assign my credit for my car to the dealer. I have a lower purchase price. So one of the things that I'm thinking here is, all right, you're going to need to show, if you want the enhanced credit, that you paid prevailing wage and you had an apprenticeship program. How do you do that? Is the IRS going to say, well, if you got a statement from your contractor when you built the property, is that going to be enough? Because there's a provision that says if you fail that and you take the credit anyways, there's a chance to cure. And the way you cure it is you find out who you didn't pay enough, you pay them back plus interest, and then you pay a small fine for all the individuals that didn't qualify or didn't get paid a prevailing wage. Can you imagine having to sort of reconstruct that 2 years down the road after a project's been complete and placed in service? And so I think you sort of need to do that now, especially if it's going to be internal information that the IRS is going to expect you to have. I also don't know if the IRS is going to take an attestation from a contractor that, oh yeah, we pay prevailing wage. Yes, we have an apprenticeship program. It might be that, it'd be best to sort of statistically sample, sort of pull some random people to make sure. These are just sort of things that I'm working through in my head, like how's it going to happen on exam and what issues are we going to face? And then you must certify that, certain steel, iron, and manufacturing product was created within the United States. So I love tax. That's where I geek out. My wife can tell you her eyes glaze over sometimes when I talk, but that's what I like. But I will never have a client make a decision purely for tax. What I want the client to do is make a business decision. Now, once you've decided, let me structure it in the most tax efficient way. I get called in after the fact a lot of time where I have very little things to play with. And so I'm like, yeah, you messed up there. Yeah, you messed up there. So I'm all about making things tax efficient. And so I have an example. We have a cost side group that goes and does buildings. They say all new buildings have charging stations. Okay, so now there's, all right, do we have credits for that? What's the recovery period? Does it qualify for bonus depreciation? Hey, are your employees going to use the EV station? Well, yeah. All right, are you going to charge your employees, or is it free to them but not to the general public? Oh, it's just free to the employees. Oh, I set one up for my CEO. Only he uses it. Okay, that's compensation. And so you run afoul of these things. You know, little things that can sort of, if you discussed it beforehand with your tax advisor, you won't run into a lot of these problems. And so there's all sorts of small questions with just the EV charging station, right? It's a great idea. You want to do it. You want to be sustainable. Just make sure you think the way through. You know, does it make sense to own them? Does it make sense to lease them? Other state, you know, have you gotten all your state and federal credits related to it? You know, did your contractor pay a prevailing wage when you put them in? I mean, these are all questions that if you deal with beforehand, can lead to a much better outcome. And you can do this with, like, you know, solar panels, anything like that. Again, I just want to make it in a tax efficient way to sort of reduce the green premium as much as possible. With that, are there any questions?